Hey everybody, Chuck Barone here. It is Monday, September the 25th, 2023, and we're off and running on another week of crazy, guys. I tell you, well, the picture's starting to get a little clearer for me at least. The market's not actually liking the news they're hearing, so they're obviously tantruming. They refuse to believe it. So it's going to be fun to watch this market play out, to actually see where the twists and turns take us, because there's always those. Although I got to admit, man, so far the Fed has been on a pretty nice little glide path toward this perfect soft landing. We'll see if it finishes. But before I get rambling on, which I do, every day here for you guys, let me take a second and welcome everybody to the show. And as always, thank you guys for your support. You guys showing up and watching these videos, hanging in there with us every day, means the world to us, guys. We appreciate you. All right, so let's talk about these markets today, guys. The conclusion now to most people, at least economists, is that the Fed is going to continue to hold rates high through next year. So the market's starting to digest this news, not really caring for it. Had a not such a great finish last week, but the market's rallying today because they just have decided now that they're just going to go their own way, regardless of what the Fed says. Should be fascinating. Let's see who's right. So the market today has just a small rally. The Dow up 43 points, back up over 34,000, 34,006, so barely over, but back over 34,000. The S&P up 17 points, 4,337. And the NASDAQ up 59 points, 13,271. So the markets, rally across the board today. Nothing big, but in the face of the news the market's been facing, not a bad day. Now the bond market's a different story because the bond market just continuing to go crazy. The 10-year today really selling off, man. The 10-year jumps 10 basis points, sitting at 4.54%. People freaking out now. Now the speculation is, will the 10-year actually hit 5%? The 2-year basically sitting unchanged today at 5.12%. So now you got the inversion really narrowing down. It's only 58 points? Wow, that's the narrowest I can remember it being for quite some time. Longer term rates jumping. We'll see, guys. We got to see how all this really plays out, because these numbers just seem to be flying in the face of the reality the Fed is painting for what's going to happen. The dollar today, though, responding to the Fed in a positive way, sitting up again on the index at 105.96 on the index. So going to break up above 106 any second. Dollar very strong right now. And that's just because the rest of the world is behind us on rates. They're behind us on knocking their inflation down. Their economies aren't doing as well in the face of their higher rates. We're kind of hanging in there. So the dollar naturally is strong. As a result of the stronger dollar, of course, gold and silver having a tough day today. Gold falling $9.90 per ounce at $1,914.90 for an ounce of gold. Silver falling 43 cents, sitting at $23.09 for an ounce of silver. I tell you guys, these prices are holding up in the face of a very strong dollar. And I believe that when the dollar comes down, these prices are going to come up pretty dramatically. So these might, if you have a little bit of extra money to invest, getting at these prices, maybe even a little lower, depending on how the dollar moves. Not a bad opportunity maybe to pick up just a little bit extra. And I'm liking silver at $23. A couple of little ounces here and there, add to your stash. Oil today, down very small, down 11 cents per barrel, sitting at $89.92 for a barrel of West Texas Intermediate. Still a high price. Gas prices are going crazy. It's funny how fast they run them up. They don't run them back down so quick. But oil prices going to torment the party in power. We're moving into an election year. It's going to be here before you know it, man. We already finished week 3 in the NFL. Well, we'll finish it tonight. Man, the weeks start clicking by, boom, boom, boom. Next thing you know, it's Christmas, and here we go. It's January 2024, and election year time, and that always just creates the biggest X factor you can have because of the wild swings you get in polling, who's leading, who's up, who's down. Markets react to that. It's going to be a wild ride for a while here, guys. Bitcoin today, down very small, down $56, 26,382 for Bitcoin. Still kind of hanging in there. It hasn't had real much upward momentum at all lately. But Bitcoin's kind of weird because when you start to look at it and get a frowny face, all of a sudden, it jumps $3,000. So Bitcoin holding its own. All right, so like we do every Monday, we're going to talk about the data we're going to get this week and how it might affect these markets. Today, just an earnings day, so earnings just starting to trickle in as we were getting ready to tape this. So we'll talk about some of that if there's anything of significance. Tomorrow, we'll get consumer confidence report, and that is expected to be down. We're going to get new home sales report tomorrow, which is also expected to be down at 698,000 sales for the year compared to what their previous estimate at 714. Higher interest rates aren't even to bite into new home sales. I talked last week or just a short time ago about the cancellation rate on new home sales. Shocking numbers. So we'll see what those numbers show. Consumer confidence will be interesting. That could maybe move the market. Or if there's any anomalies in what the market's expecting, of course, that can move markets too. Wednesday will be a little bit more quiet, but we'll get durable goods orders, which are expected to be down. Durable goods are a good indicator of how manufacturing, especially for bigger stuff in this country, appliances, stuff like that's going. We'll also get the mortgage bankers report on Wednesday, which surprisingly is expected to be up. Huh. Well, I guess when you're bound, what do they call that? The dead cat bounce, right? So these numbers are going to be interesting for us, but I don't think really anything Wednesday has any much opportunity to move markets here. On Thursday, we'll get GDP numbers. GDP. So they're expecting GDP for the third quarter to come in 2.3%. They're expecting GDP second quarter 2.1% revised. We'll see if these numbers come through. If they do, that's not terrible numbers. Not in the face of what's happening all around the world and the recession that everybody was, in myself included, was expecting us to be suffering through right now, right? We'll also get, of course, every Thursday we'll get jobless claims. This week they're expecting 206,000. Their expectations keep dropping, and the jobless claims keep dropping further. The last week they were expecting 220. They got 201. This week they're expecting 206. Let's see what we get. Jobless claims is important. As important as that GDP number, really, because GDP is the Fed's going to pat themselves on the back and say, look how good we're doing. We've raised rates all the way up to basically 5.5 here, 5.35% from zero. And we still got 2.3% growth. Look how awesome we are. We'll see how all that plays out, because they really feel like jobless claims are a big driver of the hot jobs market, is a big driver of the inflation. And now that we're down in the range where they're maybe bringing it into their target area, those are the hardest numbers to get, man. Getting from 4 to 2, from 3 to 2, really way higher than getting from like a 9 where we were down to 4. And don't forget, the numbers have been going the other way for the last 2 months. We had 3% top line inflation in June. We had, 3.2% in July, 3.7% in August. And it looks like we're going to get a little bit spike in September's reading because of the higher jump in oil prices. Okay? So numbers going the wrong way. If jobless claims come hot, that could be something meaningful. On Friday, we'll get personal spending and income for consumers. Both of those numbers are expected to be up. That's inflationary. The Fed's not going to like that, especially if it's up too high. Also on Friday, we'll get the Chicago PMI, the Purchasing Managers Index. That's expected to be down. That's another kind of look at how manufacturing's doing. And we'll also get the University of Michigan Consumer Sentiment Index, which is expected to remain unchanged. But even that, it'll be interesting to have a look at that, because that University of Michigan package has a lot of extra cool data that can give us some sense. So we'll be having a look at that on Friday. What I thought was interesting today, you know, the Fed, they came out and pretty much told us what they were going to do, right? You know, Powell had his presser. They released a lot of data, their new dot plot. It's showing that they expect one more increase this year, with the year ending 5.6%. Before this most recent meeting, they had 4 cuts of 20, quarter point cuts next year, ending the year 4.6%. They revised that as of this last week's meeting, now only showing 2 cuts and a year-end 2024 Fed funds rate of 5.1%. Now, the market, they're telling the market what they're going to do, and they have been pretty good about sticking to their guns and doing it. The market doesn't believe it. So now we have Fed officials coming out, Bowman today and a few others last week, talking about maybe needing more rate hikes. Bowman's point was interesting. She said that we need to have more rate hikes to control inflation, bring it down in this was the quote, a timely way. Okay? So basically the argument she's making, interesting, she's saying we can keep the rate elevated here at 5.35% and keep it there until we get the number we need, but we don't know how long that could take. It could take years at this rate to bring it down to target. It could never get to target. What she's saying is more hikes, slow the economy down, much better chance of getting to target quicker, right? Much better chance of getting to target at all. So I think that the Fed, like I said, they're projecting what they're going to do. And now with the new dot plot, they're really laying it out. But the market just says, well, let's see. Show. So right now, the Fed says they expect 5.6 at the end of the year. They show 5.1 at the end of next year. Well, the market's betting that there's only a 50% chance that the Fed will raise rates again this year. So it's 50-50 where at the end of the year it'll be where it is now, or at the 5.6 the Fed is calling for. And the market is still insisting 4.6 at the end of next year. So they haven't adjusted their numbers to the Fed's numbers yet. So now, market going to play out? They're going to adjust their numbers? Are they going to? So that will be coming down the road, and that could affect the market pretty negatively if they buy into the idea that the Fed will keep rates high all through next year. And again, next year's an election year, so going to make it interesting. And one last thing today, before we wrap it up, because there's just not a lot of data to talk about today. But I was reading an article in the Wall Street Journal this morning about Facebook now is going to unleash an army of chat bots on the Facebook platform to try to engage younger people. So they're going to have actual chat bots, conversing, commenting, liking, and sharing. And what could go wrong there, man? You could be talking to somebody on the interweb and it's a freaking chat bot. It's artificial intelligence, not a person. So the interwebs just keep getting murkier and murkier. Be careful out there, guys. Anyway, that's it for the day. As always, we appreciate your support, guys. We'll be back tomorrow. We'll talk about consumer confidence and some other stuff if we get the reports on a timely manner. Going to be a fascinating week. Can't wait to bring you the news you need, guys. Until tomorrow, then.